Welcome to yet another video tutorial. This has been easy for us. Today, I bring to you a very exciting topic, which I know you have heard about. All right, so in 2025, I seem to be using this model for a lot of my trades, and it went well. Okay, so uh, I felt it's very important for me to share with you so that you can do your back testing to see how effective this model is before you start applying it in real time. All right. So we are talking about CRT, candle range theory, and I know you must have heard about it or come across it. Different people teach it in different ways, but today what I'm going to try doing here is to draw your attention to the fact that there are two ways of trading CRT. All right. One of it is you can focus on directional bias. That is, first of all, you have to know which direction the market is trending in. And then you look for your key levels. And then you wait for your CRT candle to form. All right. Then you trade it. That is one way. And then the other way is you can do without the directional bias. All right. But this model that I'm going to teach you, you're not going to stay in the trade for long. This is just for scalping, quick scalp. And normally you wouldn't find them very frequently on the chart, but at least rest assured that within the week, you are very likely to find a CRT formation. All right, so let's go straight into the video. Um, when we talk about CRT, the theory holds that every candle is a range on its own. All right. So as we see here, for instance, candle one here, we have the open, low, high, close, all right, of the candle. And when we look at the high and the low, that forms the range. So we can draw our high here. Let me use the trend line too. This will be our range high. And this would be our range low. All right. So the theory says that every candle is a range on its own. And if you pick candle two, the high here will be our range high, and the low here is going to be, and the low here is going to be our range low. All right. Now, you can trade it in both bullish markets and bearish markets. So first of all, let's look at the bullish case. When we talk about CRT, we are talking about three candlestick pattern. All right. Our emphasis is on two things. Number one is on liquidity sweep of the first candle, and then we are going to trade the third candle. All right. So this is our first candle, assuming, which creates the range. Then candle two opens, decides to go down, and then makes a U-turn to go up, and then it closes back within the range. All right, the line here, the range low. As soon as we see this formation, our focus is going to shift to candle three. So we are going to allow candle three to open where candle two closed. And then sometimes price will start making a low. All right. So while price is coming down, that is where we are going to look for our entry. And then we are going to make our entry there. And we are going to set our target. So that is how we are going to be using this model. And in the case of a bearish CRT, we have the first candle, which will be our candle high. the range high and then the range low, which we are going to mark like this on the chart. All right. Now allow candle two to open and trade above candle one's high and close back within the range. All right. As this one. So like you are expecting a doji candle in to form, short to form. So once you see these two candlestick patterns, you are going to trade the third candle. So as soon as the third candle opens, once it starts to trade up, that is a good sign for you. And you are going to enter whilst it's going up. And then we are going to set our targets below here. All right. Now, let's look at the rules. So the rule says that we are going to look for a liquidity sweep. In a bullish case, candle two should sweep the low of candle one and close back within the range. Closing back within the range is very important. If the candle closed back like this, that is not a CRT. We are not going to trade it. This does not fit our criteria. We need candle two to form a doji. All right. No matter the size of the wick, the body must close inside of the range. That is the range low here. That is very important. So that is the first one. First one is the liquidity sweep of the low. We are talking about bullishness. So we are going to enter a buy trade, or we are going to go long in case we see this formation. Then number two, the second rule is that we are going to trade candle three. So once candle three opens, we are going to look for entry whilst it opens. All right. And then number three is we are going to target 50% of the range or 80% of candle one's range. So this is candle one. And we are going to use our fib to draw from the high to the low of the range. And the 50% level is going to be what? Our target. So we can target what? Our 50% level here. Or we are going to go for our 80% target. Sorry, draw from your to the high, from your low to the high. And our 50% is here, 0.5. So once we get an entry here down below here, we are going to expect price to trade up here into the 0.5 level, or we can hold up to the 0.79, which is approximately 80% level. All right. But most of the time, your 50% is assured. 50% of the range is assured. Price is likely to hit that range, even if it's not going to go up further. All right. So these are the rules that we are going to apply in trading this model. Now, in terms of entry, you are not going to use the 4 hour. You are going to use either the 15 minutes or the 5 minutes. So your 15 minutes or your time frame needs to be so little blue, and you're going to go for that target. All right. So that is what we are going to do. So it's a very effective strategy, and you will have to back test it to see how effective it is. All right. It doesn't always play out, but it mostly play out. That is what I will say. So don't forget the rules. As I've indicated here. It is the same thing for the bearish case. For the bearish case, you need one Then you switch to your 15-minute time frame and you look for what demand zones inside of this wick here, or other blocks or fair value gaps for your entry. All right. Your stop loss a little bit above candle two's high. And then you go for 15%, sorry, 50% targets of candle one's range, or you go for 80% target. So that's the model that I'm asking you examples if you will find any. So we are going to use, it's applicable in forex and synthetics, all right, but this time around we are doing the back testing on synthetics. It's a very effective model, all right. So we are going to use the 4 hour and just say VIX10. All right, so VIX10 randomly. This one, we are not going to look at any bias, okay? We are not going to look at any bias. We are just going to pick our CRT at random to see how it played out. Okay, so good. So without any directional bias, we are on the 4 hour time frame, and I'm looking at where CRT formed and it played out so nicely. We'll look at scenarios where it also failed if we have time. But in case we are not able to do that today, maybe some other time we will do that, because I don't want the video to be very long. All right. At least you should spend 15 minutes learning this thing. All right, so let's look at this side here. You see this up candle here. That is our candle one. We mark the high like that. And then you mark the low like that. So that is your range. So this is candle one. And this is candle two. You see that candle two tried to go above candle one, but then it refused to close a body outside of the range high. All right. It closed back within as a doji candle. So as soon as this candle closes, this is the candle we are going to trade, candle three. All right. Candle three is what we are going to trade. But as soon as candle two closes, we are going to switch from the 4 hour time frame to the 15-minute time frame for our entry. So we are on the 15-minute time frame, and we are going to look for our entry. So you see that this was where price went above the high of candle one and closed back within the range. And this is candle three. All right. So ideally, this was supposed to be our entry. We could use, as soon as price closed below this candle, that is our order block. So we would have expected price to come back to that zone before selling down. But in this case, price didn't come. So our entry was forfeited. You couldn't get an entry. All right. So you just let it go. But you see that it is following our criteria. First of all, there was candle one's range created, high and low. Candle two went there and refused to close candle bodies above on the 4 hour. And then we switched to 15 minutes to look for our entry on an order block. And we see that candle three opened and never came back to where we were expecting to take our entry, and that is fine. We are not going to chase trades. So if we had gotten an entry here in this zone, we would have taken our entry here, our stop loss a little above that, and we were going to go forward 50% of the range, which gives us something like 1:2 or something. 1:2. All right. 1:2. Or we could have, so let me see, from the high to the low, where is our 50%? Okay, so this would have been our 50%, almost like a 1:1, which is not too good. So in that case, what you could do is to reduce your stop loss a bit. All right. Or you increase your target from the 50% level to the 80% level so that at least you can get a 1:2 like this. All right. So this, as soon as price hits your target, you are off. You are off. So this is how you are going to do your back testing. This one, regardless of directional bias, just look for the two candlestick patterns I showed you here. Just the two candlestick patterns. If you are looking for a bullish CRT, look for these two patterns. Let it form on the 4-hour, or look for this pattern if you are bearish. If you are going to trade bearish CRTs, all right, and let it form on the 4-hour. Then you use that for your entries on the 15 minutes. It's a very effective model that we can backtest to see. So let's go back and see if we can find one more example of the CRT. Okay, so good. Here we have CRT form here. This is candle one's high. Okay. And candle one's low, sorry. So this is candle 2. You see, as it opened, it traded down, went back into the range, decided to go back and close as a doji. So this is our 2 candlestick pattern. So we are going to trade on candle 3. So as soon as candle 2 closes, you switch to what? 15 minutes time frame. 15-minute time frame. And you are going to mark your demand zone. All right, this is where we had the candle range high and the candle range low. So what is the demand zone around here? And you could see that we have this large down close candle that swept the liquidity before price came back up. So you could have marked that zone like that. Expect candle 3 to open trade back into 8. So you go for your entry there. All right. Put your stop loss a little below the low here. And then at least aim for 1:2. All right. And you could see that almost your 50% or 80% was reached. If you want to use your fib, you can use it from your low, candle range low to your candle range high. And then you're going to target 50%. So this was 50% here, which is almost like 1:1. So I said in that case, you can go for 80% around the 0.79 here, which gives you 1:1.8, which is not bad for a scalp, all right? Or you could likewise reduce your stop loss a bit so that you can get 1:2 or 1:3. Good. And that was going to be a very good trade for you. All right. So this is a scalping strategy that you can learn and apply. So your time frames are going to be from the 4 hour, you switch to the 15 minutes. If the 15 minutes is not giving you any good order block, you can go to the 5 minutes, all right, for your entries. And you are good to go. So continue to practice this and let's see how this plays out. Once you are getting a high win rate, it means it's a model that you can rely on for setups. All right. They don't normally form, but when they form, they really play out nicely. Most of the time, candle one should be a large volume candle. All right. Large volume means that the body should be quite huge, like these ones. These ones like this are not too nice. All right. Look for a candle with a huge volume so that you can get a long range to trade. All right. So looking around here, do you see any CRT here? I can see one here, candle one, candle two, candle three, but candle three failed. All right. So this one you may have taken a loss, but look at this one here. Candle one, candle two went up, refused to close above, is closed within. So if you are marking our range high, we will mark it here. And if you are marking our range low, we will mark it here. So without any directional bias, we can tell this one is what, a bearish CRT. Why? Because the high of the candle one was swept and the candle closed back within the range. All right, it didn't close above, a body above. So you switch to 15 minutes and then you look for entry on candle three and you target either the 50%, 80%, or even the range low. You can target that. Look at this case here. We have the range high, candle one's high, candle one's low, and the two failed to close above candle one. So you switch to 15 minutes, you look for your entry right there. And then you take your trade. You can see another one here, candle one. Here, it looked a bit tricky because candle two's body closed right above candle one, but still candle three traded down with a large volume. This is a large volume bearish candle, which was very good. And then right after that, you could see price form another CRT candle one, candle two, but candle three failed to trade up. So once you get this trade, you are out for the day. You're off, you just leave. All right, don't overstay so that you give your profit back to the market. Here, just go through the chart and look for these two candlestick patterns, and then you see how you could have traded them on the 15 minutes. So if you like the video, make sure that you like, subscribe, share. This has been easy for us. More goodies are loading. I'm going to load more of these strategies for you. Simple strategies that you can apply for your trades. All right. Thank you so much. See you soon. Bye-bye.